If you look at the ticker tape today, the financial markets are telling you a very comforting story about silver. They are telling you it is abundant. They are telling you it is just another volatile asset for speculators to gamble on. That story is a dangerous lie. What is actually happening beneath the surface of the exchanges is a systemic fracture. We are witnessing a historic collision between a paper market that says surplus and a physical reality that screams emergency. While American markets are busy trading derivatives and arguing about quarter-point interest rate moves, our strategic competitors are quietly draining the physical inventory. They are securing the actual metal required to build the next generation of energy, defense, and technology, while we are left holding paper promises that cannot be delivered. This is not a conversation about investment advice. This is a conversation about national security, institutional complacency, and the inevitable collision between financial fantasy and geological reality. The United States is currently shorting its own future. Today, we are going to look at exactly how that happened, why the warning signs were ignored, and what happens when the physical bill finally comes due. Most people who follow financial markets have a reflexive, almost muscular reaction when the subject of silver comes up. It is a reaction born of experience. You dismiss it. You categorize it as a playground for speculators, a trap for the naive, or a relic of a monetary era that ended 50 years ago. And frankly, for the better part of 3 decades, that skepticism was an intellectual survival mechanism. If you took silver seriously, you lost money. If you treated it as a structural signal, you were laughed out of the room. It was the widowmaker trade, volatile, cyclical, and fundamentally unserious. So, let's start by acknowledging that baseline. If you are sitting there thinking that silver is a sideshow to the real economy, something for preppers and day traders, you are operating on a set of assumptions that were perfectly valid in 2010. They were largely valid in 2019. But we are not here to talk about history. We are here to talk about a fracture that is opening up right now, in real time, beneath the surface of the Western financial system. We need to talk about what happens when a market stops functioning as a price discovery mechanism and starts functioning as a camouflage for systemic stress. The story you have been told, the story the futures markets are currently telling you every morning when the bell rings in New York, is that silver is abundant. The price action signals indifference. It signals that supply is adequate, that demand is lukewarm, and that this metal is just another commodity moving in lockstep with the dollar index or interest rate expectations. That signal is a lie. I don't use that word lightly. In economics, we prefer terms like inefficiency or mispricing. But we have passed the point of polite academic euphemism. When the digital price of a critical strategic asset screams surplus, while the physical inventory of that asset screams emergency, you are no longer looking at a market. You are looking at a broken instrument. You are looking at a compass that points south while you are walking north. Let's look at the mechanics of this lie, because it is the key to understanding the danger the United States is currently sleepwalking into. Right now, if you look at the paper markets, the futures contracts, the derivatives, the endless flow of digital promises traded in London and New York, you will see record levels of short positioning. The smart money, the institutional capital, is betting heavily that the price of silver will not rise. In a normal market, a healthy market, this would indicate that the world is awash in metal. It would mean mines are overproducing, industrial users are cutting back, and warehouses are overflowing. But when we step away from the screens and look at the physical world, the world of shipping containers, vaults, and industrial fabrication, we see the exact opposite. We see a deficit that has persisted for years. We see inventories in London and New York draining at a pace that is mathematically unsustainable. We see a metal that is no longer just a store of value for the paranoid, but a critical, irreplaceable industrial input for the technologies that define the 21st century. This is the first contradiction, and it is the one that should make you uncomfortable. Silver is unique. It is the most conductive metal on the periodic table. You cannot build a high-efficiency solar panel without it. You cannot build an advanced electric vehicle without it. You cannot build the guidance systems for the missiles currently depleting our stockpiles without it. It is not just money. It is the nervous system of modern industry. So, ask yourself, why is the Western financial system betting against a strategic material that is in a structural deficit? Why is the price languishing when the physical supply is tightening? The standard answers, the ones you read in the financial press, are lazy. They talk about market sentiment. They talk about the strength of the dollar. They talk about algorithms trading technical patterns. These are explanations that worked when the physical market had slack. They do not work when the cupboards are bare. What we are witnessing is a decoupling. We are seeing a divergence between the paper price, which is set by leverage, algorithms, and legacy financial flows, and the physical reality, which is governed by geology, mining costs, and insatiable industrial demand. For decades, the United States has enjoyed the privilege of determining the price of global resources through its financial markets. We assumed that because we control the futures exchange, we control the asset. We assumed that if the COMEX says silver is $20-something an ounce, then that is what silver is worth, and the world will deliver it to us at that price. That assumption is the vestige of an era that is effectively over. It relies on the belief that there will always be enough physical metal to back up the paper promises. It relies on the belief that the rest of the world will continue to accept our paper price for their hard assets. But look at the data. The inventories are not replenishing. The deficits are not closing. The mining supply is flatlining because you cannot print a silver mine, and you cannot permit one in a time frame that matters to this crisis. We are watching a train wreck in slow motion. On one track, you have a financial system that is structurally short, reliant on the idea that it can always suppress volatility with more paper. On the other track, you have an industrial reality that is running out of metal. This is not a trading opportunity. I am not telling you this so you can open a brokerage account and buy an ETF. I am telling you this because it is a warning light on the dashboard of American economic power. If the price mechanism is broken, then the market is blind. And if the market is blind, it cannot allocate resources. It cannot signal scarcity until it is too late. It creates a false sense of security, lulling policymakers and industry leaders into believing that resources are cheap and plentiful, right up until the moment the delivery truck doesn't show up. We are living through a suspension of disbelief. We are pretending that the paper map matches the physical territory. But every ounce that leaves a Western vault and heads east, every solar panel that gets installed, every month that this deficit compounds, the tension builds. You cannot print silver. You cannot quantitative ease your way out of a geological shortage. So we arrive at the uncomfortable truth. The volatility you see, the confusing price action, The refusal of the market to break out, it isn't just noise. It is the sound of a legacy system grinding its gears, trying to force a new reality into an old framework. Something fundamental is misaligned. The gauge is stuck. And if this isn't just speculation, if this is actually a breakage in how we value strategic reality, then we have to ask the question that nobody in Washington or on Wall Street wants to answer. If the price is wrong and the market is broken, what happens when the physical reality finally asserts itself? Because it will. Reality always wins. The only variable is how much damage the collision causes when it finally happens. To understand why this disconnect is so dangerous, we have to go beneath the surface. We have to look at the machinery of how prices are actually set, and why that machinery is stripping the United States of its strategic advantage. For generations, the Western financial system, centered in London and New York, has operated on a premise that works beautifully in a stable world. The premise that leverage creates liquidity. The futures market was designed as a tool for hedging. If you were a miner, you sold silver you hadn't dug up yet to lock in a price. If you were a manufacturer, you bought paper contracts to stabilize your costs. It was a system of promises, greased by banks who acted as the middlemen. And for a long time it worked. It kept volatility down. It kept supply flowing. It allowed the United States to effectively manage the global price of commodities without ever having to get its hands dirty digging them out of the ground. But this system relies on one critical, non-negotiable condition. There must be enough physical slack in the system to honor the promises if someone actually asks for the metal. The casino only works if everyone knows the house has the cash in the vault. You don't need all the cash, but you need enough to prevent a panic. What happens when that slack disappears? We are currently watching the collision between the paper economy, where we trade contracts, derivatives, and ETFs, and the kinetic economy, where actual things are made. Let's walk through the physical reality of silver for a moment. This isn't code. This is geology and logistics. Silver is difficult to mine. It is energy-intensive to refine. It is geographically concentrated. The vast majority of it comes from the ground as a byproduct of mining other metals, lead, zinc, copper. That means you cannot just turn on silver production because the price goes up. If the world needs more silver, but doesn't need more lead, the silver stays in the ground. The supply is inelastic. Now, layer on to that inelastic supply a demand profile that has completely transformed. 20 years ago, silver was for photography and jewelry. Today, it is being devoured by the green energy transition and the defense industrial base. The industrial absorption rate is relentless. So you have a physical market that is tight, brittle, and running at a deficit. Enter the rational state actor. While Wall Street and the City of London have been busy trading paper contracts to capture arbitrage pennies, other nations have been looking at the board with a much wider lens. I am talking specifically about China, but also India, Russia, and other sovereigns who have decided that in a fracturing world, possession is the only law that matters. We need to be very clear about what is happening here. This isn't a conspiracy. It is a strategy. China understands something that American policymakers have forgotten. Price is not the same thing as value. While Western funds are shorting silver futures, betting the price goes down, Chinese state-backed entities and industrial hubs are standing on the other side of the trade, saying, "Thank you, we will take the metal." They are using our broken pricing mechanism against us. When the COMEX allows leverage to drive the price of silver down, We are effectively subsidizing the reindustrialization of our strategic competitors. We are putting a discount sticker on a critical strategic asset, and they are clearing the shelves. Look at the export numbers. Look at the inventory drains from the London Bullion Market Association. The metal is moving from west to east. It is leaving the vaults where it supports Western financial derivatives, and it is entering the stockpiles where it supports Eastern industrial dominance. This is a transfer of wealth, but more importantly, it is a transfer of capability. The United States is currently behaving like a gambler who thinks he is winning because he has the most chips, while his opponent is quietly buying the casino. We are obsessed with the financialization of the asset. Can we trade it? Can we hedge it? Can we lever it? Meanwhile, our competitors are obsessed with the materialization of the asset. Do we have it? Can we build missiles with it? Can we dominate the solar supply chain with it? This is where the complacency of the American system becomes a national security liability. We assume that because the dollar is the reserve currency, we can always just buy what we need. We assume that the market will always be open to us. We assume that price solves all shortages. But what happens when the seller stops caring about the dollar price? What happens when a nation imposes export controls on silver, classifying it as a strategic mineral, which, by the way, it absolutely is? We are seeing the early stages of this right now. State actors are beginning to treat silver not as a tradable commodity, but as a matter of national security. They are stockpiling. They are restricting exports. They are prioritizing domestic industry over international markets. The United States has no coherent framework for this. We have left our strategic resource policy to the free market. But the market isn't free. It's distorted by paper leverage that masks the danger. We are entering a period where control over the pricing mechanism is becoming irrelevant. You can suppress the paper price of silver to $10 an ounce if you want. You can sell 1 billion ounces of paper silver on the futures market tomorrow morning. But if you cannot deliver the bar of metal to the factory in Ohio that makes guidance chips for the Navy, the price on the screen is meaningless. We are seeing the end of the illusion that financial leverage equals strategic control. The leverage has already shifted. It shifted quietly while we were arguing about inflation rates and stock buybacks. The physical leverage is now in the hands of those who hold the metal, not those who hold the short contracts. And the terrifying realization is that the market cannot self-correct this imbalance without a crisis. The only way for the market to clear now is for the paper scheme to break, for the bluff to be called. We have built a financial structure that assumes a world of infinite resource availability and trusted trade partners. That world is gone, and we are left holding a bag of paper promises in a room that is rapidly running out of oxygen. The belief that we can manage this through standard market operations, that the invisible hand will fix a structural geopolitical imbalance, is no longer tenable. We are not just losing money on a trade, we are losing control of the physical foundation of our economy. This brings us to the question that transforms this from a market anomaly into a national emergency. What actually breaks when the illusion fails? We're not talking about a bad quarter for a few hedge funds. We're talking about the tangible, physical wiring of American power. Think about the industries that the United States has staked its future on. We are betting the farm on the energy transition. We are betting the farm on reshoring advanced manufacturing. We are betting the farm on maintaining a qualitative military edge over our competitors. Every single one of those bits requires physical silver. You cannot have a solar revolution without silver paste. You cannot have an electric vehicle fleet without silver contacts. You cannot have the advanced electronics that power the F-35 or the guidance systems of our cruise missiles without high-purity silver. It is a choke point. And right now we are treating this choke point with the casual indifference of a nation that has forgotten what scarcity feels like. If the paper price of silver snaps, if the physical shortage forces a repricing that the futures market can no longer suppress, the shock wave does not stop at the commodity exchange. It travels instantly into the cost structure of the American economy. Imagine a scenario where an aerospace defense contractor cannot secure the silver inventory it needs because the metal has been cornered by a sovereign competitor in Asia. Imagine a scenario where a massive solar infrastructure project in Arizona grinds to a halt, not because of funding, but because the raw material costs have exploded overnight, shattering the contract economics. This is where the volatility moves from the screen to the street. It manifests as cost inflation that the Fed cannot fight with interest rates. It manifests as broken supply chains. It manifests as a strategic humiliation where the United States, the architect of global trade, is forced to stand in line and pay a premium to nations that planned ahead. And we must be honest about why we are so vulnerable right now. This is not just bad luck. It is the result of a decade of institutional vandalism. We have spent years eroding the very institutions that allow a superpower to think long-term. We have replaced strategic planning with impulsive reactionism. We cannot ignore the damage done by the chaotic, transactional approach to governance that defined the Trump years and continues to fracture our political cohesion today. When you treat trade policy as a weapon for short-term leverage rather than long-term stability, you break the trust required to secure resources. When you treat alliances as protection rackets, you find yourself alone when the supply chain creates a crisis. The incoherence of American industrial policy, oscillating between isolationism and interventionism based on the news cycle, has left us exposed. Our competitors saw this chaos. They saw a United States distracted by internal cultural warfare, distracted by the dismantling of its own administrative state, and they used that time to secure the physical assets we were ignoring. So, when the silver squeeze comes, and the mathematics suggest it must, it will hit a U.S. system that is uniquely unprepared to handle it. Consider the financial fallout. The entities holding these massive short positions, the ones betting against reality, are not small players. They are often systemically important financial institutions. If they are forced to cover their shorts in a disorderly market, the losses will be catastrophic. Who steps in? The central bank? Do we bail out the banks again because they sold metal they didn't have? Do we print more dollars to buy silver that is rising in price because there are too many dollars? You see the trap. A disorderly repricing of silver is a direct attack on the credibility of the U.S. dollar system. It signals to the world that the price discovery mechanism in New York is fraudulent. It signals that if you want safety, you should not hold U.S. treasuries. You should hold what the Chinese are holding, hard assets. This is the systemic consequence. We are risking a loss of institutional authority. If the market breaks, it proves that the United States can no longer guarantee the rules of the game. It proves that our financial leverage has been hollowed out by physical reality. The pain of this correction will not be distributed equally. It will not be the emerging markets that suffer most. They have been accumulating metal. It will be the Western consumer, the Western taxpayer, and the Western military-industrial complex that bears the brunt of the shock. The costs of our inaction are no longer theoretical. They are compounding daily, and when the bill finally comes due, it will be asymmetrical. It will fall squarely on the United States. We are the ones who are short. We are the ones who are unhedged. We are the ones who have mistaken the map for the territory. And right now, we are running out of road. There is a seductive fantasy that permeates American discourse whenever we face a structural problem. It is the belief that this will simply blow over. We tell ourselves that the market will cycle, the shorts will cover, the price will normalize, and we will return to the comfortable status quo of the last 30 years. I need you to understand that that era is dead. It is not coming back. If you look at the trajectory we are on, there is no version of the future where this resolves itself without pain. The math simply does not allow for a clean exit. Consider the incentives currently locked into the system. As long as the Western paper markets continue to suppress the price, we continue to discourage the development of new mines. We continue to make it unprofitable to recycle industrial scrap. We continue to signal to the world that silver is cheap. And what does a cheap strategic asset do? It drains. It flows downhill from the places that undervalue it, us, to the places that value it correctly, our competitors. Every day that we maintain this illusion of abundance is a day we subsidize the strengthening of rival powers. We are effectively paying them to take the keys to the future economy out of our hands. This trajectory does not self-correct. It compounds. The longer we suppress the signal, the more violent the eventual correction becomes. If we had let the price rise naturally 5 years ago, we might have stimulated enough production to meet demand. We didn't. We chose the comfort of low volatility. Now the hole is too deep to fill with a few new mines. It takes 10 years to bring a deposit online. We don't have 10 years. We have to confront the reality that markets are no longer neutral mechanisms. For the last half-century, the United States has treated the global economy like a public utility, a neutral zone where everyone follows the rules and the best price wins. That is not how the world works anymore. Markets are now arenas of geopolitical competition. When China locks down silver supply, or Russia accumulates gold, or nations trade in currencies other than the dollar, they are telling us that the financial system is a weapon, and they are arming themselves. Meanwhile, we are still staring at the charts, drawing technical lines, and arguing about quarterly earnings. This is the reckoning. Silver is not the crisis itself. Silver is the diagnostic. It is the canary in the coal mine that stopped singing a long time ago. It is a polite, quiet warning that the systems we rely on, the assumption of infinite supply, the assumption of dollar dominance, the assumption of market supremacy, are fracturing. It is a signal that arrived early. It gave us time, and we have squandered that time on denial. The window for a painless correction has closed. The United States now faces a binary choice, and it is a choice that will define our economic sovereignty for the next generation. We can continue to pretend that financial leverage is the same thing as power. We can continue to let algorithms dictate the value of critical resources. We can continue to drift reactive, and distracted, while the physical foundation of our economy is hollowed out. Or we can wake up. We can accept that in a world of scarcity, he who holds the gold, and the silver, and the copper, and the lithium, makes the rules. We can relearn the discipline of strategic planning. We can start valuing resilience over efficiency. But make no mistake, the market is going to reset, with or without our permission. The physical reality of silver is going to assert itself against the paper delusions of Wall Street. The only question left is whether the United States will be driving that transition, or whether we will be its primary victim. The warning light is flashing. It won't stay lit forever. Eventually, the engine just stops.